Okay, we are now recording. So welcome everybody. Our session will soon begin. Again, this is City of Toronto's End of Mortgage Framework webinar number 2. If you are currently here as an attendee, thank you so much for coming. We'd love if you could share your name, the housing provider or organization that you're a part of, and maybe what you're looking forward to learning today during this session. Anything that you can share with us in the chat would be helpful. So share your name, the housing provider or organization that you're representing or that you're here from, and anything you're looking forward to learn about today. You can share all that information in the chat. All right, let's get started with our opening slides. So welcome to today's webinar. In terms of audio and video controls, it's important that you know today's session is being recorded. But don't worry, if you're in the audience, everyone's microphone and camera is off and cannot be turned on. So we cannot see you and we cannot hear you. The only people who you'll be able to hear and see today are our panelists and our presenters. There is a closed captioning option that you can turn on. That feature is available. It's located at the bottom left side of your screen. You'll see a speech bubble that has CC in it. If you click the down arrow, it'll give you options to turn on or turn off the closed captioning. So feel free to use that if you'd like. Now let's talk about the chat. You can use the chat to speak with other attendees and to ask questions. So today we highly encourage any questions you might have about end of mortgage, you get them out there as soon as possible. Please be aware your chats can be sent privately or publicly. There are 2 tabs. The second tab is direct, where you can send private messages. When you are typing your questions in the chat box, it's really important that you are as clear and succinct as possible. Bear in mind there are people who are also typing questions too, so please stay aware of the questions in the chat box and try not to ask the same question twice. We'll do our best to facilitate answering all your questions, but if we can't get to your questions, don't worry. We will have a Q&A document that we will be sending out at the end of this webinar series. Oh, and I shouldn't forget to tell you that we have a Q&A portion at the end of this webinar. So again, to clarify, questions will be answered at the end of this webinar. All right, so before we go into our introductions, if you haven't had the chance yet, if you are here as an attendee, please in the chat let us know who you are, what housing provider organization you are here from, and if you have any questions or if you'd like to know any information about today's session, okay? All right, let's go into our introductions. So firstly, from HSC, I'd love to introduce Judy Lightbound, Mark Post, and Jennifer McMahon. Then from the City of Toronto, we have Paul Fisher and Michelle Sumner Williams. We also have Maria, Aline, and Layla. From CHFT, we have Tom Clement and Lindsay Denise. And from OMFA, we have Marlene Coffey and Andrew McKenzie. With all that being said, I'd love to hand this over to my lovely colleague Layla, who will take very good care of you during this webinar. Should you have any questions, I'll be in the comments and in the chat helping you all out. Enjoy, and over to you, Layla.
Thanks, Colleen. Hi, everyone. Before we jump into today's meeting, we're just going to start off with a land acknowledgement. Although we may be in different places today, the City of Toronto acknowledges that we are on the traditional territory of many nations, including the Mississaugas of Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples, and is home to many diverse First Nations, Inuit, and Métis people. The city also acknowledges that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. And I'm just going to ask Alim to read our African ancestral acknowledgement.
The City of Toronto acknowledges all treaty peoples, including those who came here as settlers, as migrants either this generation or in generations past, and those of us who came here involuntarily, particularly those brought to these lands as a result of the transatlantic slave trade and slavery. We pay tribute to those ancestors of African origin and descent.
Thank you. And I'm going to pass it over to Paul for some opening remarks for us.
Hi, everybody. Paul Fisher here, manager of the Community Housing Administration team. Good morning, and thank you for joining on behalf of the Housing Secretariat. Want to thank you for coming and welcome you all here. We really appreciate you taking the time to be here today to discuss end of mortgages, and there's lots of familiar names on the call, so it's great to have everyone in the same room, the virtual room together. I just wanted to start by recognizing and thank you all for the critical role you all play in contributing to the housing system in Toronto and in providing affordable and supportive housing across the city. We're at a really exciting point in the evolution of our housing system as mortgages start to come to an end, and we've been working closely with the sector to prepare for what comes next, and that's where the end of mortgage framework comes into play. This framework forms part of the city's broader housing strategy and is really about modernizing the system and how we support and work together. But at the heart of this is a new operating and funding framework that renews our partnerships, helps preserve housing, and ensures you are able to maintain good quality homes. We have an aging housing stock and a growing demand for affordable homes. So this new framework is really about making sure we protect what we have and keep it viable for the long term. We truly see this as a renewed partnership with all of us working together toward the same goal. Thanks.
Thanks, Paul. Okay, so today's session, we're going to provide an overview of the Community Housing Partnership Renewal for End of Mortgage Framework. We're also going to provide information on the financial plan development process, implementation, timelines, and next steps, and opportunities to work together to support positive housing outcomes. And we'll also have an opportunity near the end of our presentation to hear from ONFA and CHFT, followed by a question period. Over to you, Mark.
Great, thanks. Hello, everyone. My name is Mark Post. I'm the Managing Director of the Business Solutions Division here at Housing Services Corporation. For today's meeting, we'll be using the chat feature to support asking questions during the meeting. As Colleen mentioned earlier, at the end of today's session, the group will try to answer all questions raised during the meeting. However, time may be a factor. There's a lot of material to go through here. We did do one of these sessions yesterday and we got through all the questions, but every day may be a little different depending on the number of questions we receive. So we will also be compiling all questions asked during the meeting and turn them into a Q&A that can be shared with the group and others during future EOM sessions. So we encourage you to type your questions into the chat during today's meeting. One note, we are hoping to answer questions that are general or high level around EOM so that our responses support the learnings of everyone on the call. We're hoping that the group can save any questions that are particular to your organization's situation and share them directly with your housing consultant after today's meeting. Oops. If you've joined us today, the mortgage for your nonprofit and co-op has either been fully paid off or will be shortly. So first off, congratulations. That's great news for the organization. End of mortgage, or EOM, as we'll call it throughout the presentation today, truly presents opportunities for the board, staff, and members to consider your future. We're here today because the city is committed to supporting you to sustain your housing asset and also wants your organization to explore the opportunities that come with EOM, such as renovations, new developments, mergers, acquisitions. City wishes to use this opportunity to create a new partnership framework. Transitioning to this new partnership will require continued engagement between the city and you as the housing provider. So this is really the beginning of this in this transition process. Okay, I'm going to pass it back to Leila with the city to do some context setting for today's meeting.
Thanks, Mark. We'll head into the context portion. So why are we here? So you are key partners in delivering affordable housing, quality homes across the city. And we want to work together to preserve the community housing stock and really create conditions that help maintain and strengthen the existing housing projects. So this presentation will be an overview of the framework and also to really launch our partnership renewal discussions with the aim of having, more supported and informed conversation as we move forward together. Okay, so to provide some context, so in June 2024, City Council adopted the Community Housing Sector Modernization and Growth Strategy, So at its core, this strategy really recognized the important role you play and really aims to strengthen the sector's sustainability and capacity. Specifically, one of the initiatives was focused on end of mortgage, really recognizing the unique transition that comes when a mortgage is mature. So building on this council's approval of the strategy, the Community Housing Partnership Renewal Program for End of Mortgage, or we might refer to it as CHIPRE EOM, was developed. So in other words, it provides the framework for how we move forward together under these renewed partnerships. But overall, this work is really about ensuring a smooth transition while supporting the long-term viability and success of your housing projects. Okay, so we do have, at a high level, the goal for this framework is to really establish sustainable partnerships that strengthen the housing system, preserve affordability, well-maintained homes for current and also future residents. So it's not just about responding to today's challenges, it's about building a system that is positioned to serve communities over the long term. So this work really builds on the strong foundation we already have together, with the foundation we've already established, and reflects our collaboration and our shared commitment that have brought us to this point, while also recognizing, the needs of the sector are evolving, and also to have guiding principles for that underpin our framework are shared accountability, long-term sustainability, partnerships, and fiscal responsibility. So taken together, these principles help guide collaboration and forward-looking approach as we move ahead. Okay, so I also want to acknowledge the significant amount of work that's already taken place across the sector to prepare for end of mortgage. So in 2024, the city developed the end of mortgage discussion guide to serve as a foundational tool to help support early planning and decision making for end of mortgage. So through this process, you've already done a lot of work already. You've identified your organizational priorities, you've considered operational impacts, and also explored opportunities in a post-mortgage environment. So this work has been critical in helping position you for what comes next, which is partnership renewal. And we're really building on that strong foundation as we move into this phase. So partnership renewal is really about taking that planning work that you've done and turning it to action to operationalize the framework. And ultimately, continued collaboration is going to be key to ensuring a smooth transition and to advancing the housing system that supports both current and future tenants.
Okay, great. Thanks, Lila. Again, I'm Mark Post, and I'm happy to be here today working with all of you dedicated housing providers and co-ops, nonprofits, and alongside our partners at the City of Toronto. I've been in the housing sector or world for the past 18 years and know how important the work is that all of you do for the community. So I just wanted to start off by saying thank you for everything that you do for the community. As Paul mentioned, such an important part of our community. So thank you, first off. So end of mortgage is a pretty big deal for the housing sector, and it's something that we've been working up to since the mid-'80s. Most of the housing providers that were developed in Ontario during that time were referred to as provincial reform projects. When the projects were developed, the boards entered into contracts called operating agreements with the province. And these operating agreements laid out the terms and conditions that the housing providers had to meet. And they typically lasted for about 35 years. In 2002, the province passed the Social Housing Reform Act, which did a few things. It officially created the 47 service managers across Ontario, like the City of Toronto's Housing Services team. It created the Housing Services Corporation, which is our organization to help support the sector with insurance and other programs. And it voided the operating agreements previously created with the housing providers across the province. So hundreds of housing providers across the province. The operating agreements were replaced by the Social Housing Reform Act, which is today the Housing Services Act. And this change, and with this change, there's really no end date to the obligations of the housing provider and service manager. So this is a big deal, and you're not alone. Every service manager in Ontario and all of their nonprofits and co-op housing providers created during this time are all in the same boat. You can see this in this graph, which shows the 139 nonprofits and co-ops in Toronto and the years that their mortgages expire. A number of providers started to hit EOM in 2021, 2022, and things rise to the highest level over the next few years and then decrease down to zero. And that matches the development cycle that all of these projects were built under 35 years ago, so between 1986 and 1998. So there are hundreds of providers across the province that are starting this journey with their service manager. In Toronto, this shift represents some 15,000 units, so big numbers. Now, leading up to these end of mortgage dates, no one truly knew what this new legislative agreement was going to look like for housing providers as they approached their end of mortgages. Because the funding formulas that the act, in the act, they were largely based around mortgage payments. But in 2022, the province passed regulation that allowed housing providers to update the relationship between outlined in the Housing Services Act by entering into a new agreement with their service manager, in this case, in your case, the City of Toronto. And since that time, the sector and service managers have worked towards developing new funding and administrative relationships with their providers. So the province laid out expectations for what this process was going to look like. And it required that service managers and housing providers first develop joint financial plans that must identify how many RGI units will be funded and the funding approach to support the operating and capital requirements of each provider. And then two, it also required service managers and housing providers to formally sign a service agreement that has a term of at least 10 years, includes funding elements identified in the jointly developed financial plan, and identifies the reporting requirements, consent provisions, and how the two sides would resolve disputes that may arise during that time. This process would effectively replace this Housing Services Act and set housing providers on a new path forward and a new relationship with their service managers. The development of this service agreement between you and the city is the city's commitment to continue to provide your organization with the funding to support your financial viability. And it's your organization's commitment to continue to provide RGI and affordable units for the community. The obligation to provide RGI and affordable housing units in the community must include the number of RGI units that your organization will provide, that you're filling the RGI units using the city's wait list, that you continue to partner with our organization, Housing Services Corporation, through the different legislative programs that we provide the sector, such as insurance and investment programs, and any other commitments that are jointly established through the negotiations with the city. So in very broad strokes, through this EOM process and the development of the service agreements with your organization, the city's looking to renew its partnership with nonprofits and co-ops, support you to preserve your housing assets and grow your units where that makes sense, and to support you in realizing the vision for your organization. In order to achieve that goal, as I mentioned earlier, the city and your organization are required to jointly develop 5-year financial plans. And these plans must outline your organization's operating and capital needs, identify how you agree, how the agreed upon subsidy will meet those needs, and also must include a capital plan for your assets. And a lot of those, a lot of that work has already been done between you and the service managers around BCAs for your buildings. It is intended to set your organization's direction for the next 5 years, and the plan is required to be reviewed and updated for another 5 years once the initial financial plans expire. An important part of the financial plan development process is the review of your market rent charges since the city's funding covers the RGI gap only. But keep note of that as we move through today's meeting, because the city's team will be sharing the funding model detailed a little bit later in today's meeting. So as I mentioned earlier, end of mortgages is a pretty big deal. That comes with it some opportunities for your organization to reimagine its future. The opportunity to receive predictable funding to align with your organization's strategic goals and objectives, to invest in your buildings and provide good quality housing for your residents, to streamline your funding relationship with the city, and to participate in the city's growth and modernization strategy for the community housing sector. So EOM is a really important time for the housing sector and for the community more broadly. As I mentioned earlier, the units within your portfolios are such an important part of our community, and the need for affordable housing has never been greater. Again, I'm happy to be here today with all of you and look forward to the conversations to come in today's meeting. So with that, that's my high level overview of end of mortgages and what they mean for your organization and for the city. Up next, the city's team will be introducing their EOM funding overview. So I'll pass it over to Alim with the city to start the conversation around the City of Toronto's EOM approach. Thanks.
Thank you, Mark. All right. Now we'd like to take you through the funding framework in far more detail. So this is where we talk a little bit about the program and what it means for your organization and some of the terms and conditions that govern it, especially the funding. So the Community Housing Partnership Renewal for End of Mortgage, or CHIPPR EOM is what we're calling it, will consist of a new operating and funding framework that will support the sector in three key ways. It'll support the protection of critical housing supply. It'll allow the city to continue funding housing providers to fund affordable and deeply affordable housing. And it supports maintaining assets in a good state of repair. The new operating and funding framework is outlined under two key agreements between yourselves, a housing provider, and your corporation, and the City of Toronto. One is the service agreement, and the other is a municipal housing project capital facilities agreement, or the contribution agreement. So let's talk a little bit about these two agreements and go into details about them. These two agreements will be what your corporation enters into with the City of Toronto. So the first one is the service agreement. The purpose of the service agreement is really to govern the funding, accountability, and define the roles and responsibility between both parties. It will take place over a 20-year term, and it provides long-term stability and predictable funding for your operations. It supports the requirements of a Part 7.1 housing provider under the Housing Services Act. This Part 7.1 is the new section for EOM providers specifically under the Housing Services Act, whereas right now your project is under a Part 7 of the Housing Services Act. So entering into this agreement will transition you from a Part 7 over to a Part 7.1. There are two key schedules involved, and one of them Mark talked a little bit about earlier. The first is the 5-year financial plan. Essentially, it's a 5-year operating budget. So what is your corporation doing from an operating standpoint? But importantly, what is your corporation doing from a capital planning standpoint that outlines any sort of investments in maintaining and repairing your housing assets over the next 5 years? It also includes the city's subsidy. So this refers to the rent supplement funding provided by the city. The financial plan will be reviewed every 5 years. This is done on purpose to ensure that city funding remains current and responsive to your changing needs. So we understand that things change over 5 years. So we want to make sure that the funding is adequate and it continues to address your financial realities over the next 5 years. When we review your financial plan every 5 years, we do take into account both your operating and capital need outlooks, and the subsidy could be potentially adjusted accordingly. The second key schedule is the access plan. So this is a document that really outlines how tenants will access your project, both for your RGI units, your rent supplement units, and your market rent units. The second key agreement is the contribution agreement. So this is the city's tool to provide property tax relief to your corporation. It exempts you from property taxation, both from municipal and the provincial education portions. This term is aligned with the service agreement to match the 20 years, and it is a key term of the contribution is to ensure that all units within the project meet the definition of affordability. And I'll talk a little bit about that definition means. So we're moving away from this prescriptive provincial benchmarking that's been used for a number of years now. So the province annually releases benchmarking, and that's how we were usually defining our affordability standards. However, it's not quite reflective of the current situation or the current realities, your operating realities in the city of Toronto. So what we're doing is we're moving towards the city's definition of affordability, which is based on the Canada Housing Mortgage Corporation, or the CMHC's average market rent. The CMHC's average market rent is it's a survey that's released every year that determines the average market rents for rents across the city of Toronto. So affordability will now be defined at 100% of CMHC's average market rent. This approach is designed to better reflect the current market rent conditions in the city of Toronto. So at a high level, this is how your corporation operates. And I'll show you how the role the city's funding plays a role in supporting your activities. So this is sort of taken from an income statement point of view. I'll go through each of these boxes in far more detail, but at a high level, essentially we have revenue, so it's how much your corporation is making. We have operating expenses, how much your corporation is spending, and the difference between the two is your net operating income, or another word for your surplus. And the program, I'll show you how this is sort of done, but it will allocate that surplus into two paths, one being the capital reserve fund and the other being the accumulated surplus. So now I'll go into details as to how, through the service agreement, each of these will be sort of governed. So let's start with revenue. So on the revenue side, for the purposes of this program, there are two key sources of revenue. We have market rent and we have the RGI subsidy. So Mark had mentioned this before, but we ask that when you are completing your financial plan, you really take a hard look and evaluate your market rents and ground them in your financial reality. It's important that to understand your financial reality and some of the upcoming expenses, capital or operating you might have and how you will cover paying for them. So you need to adjust your market rents accordingly. There are limits on affordability. The first limit is that market rent tenants cannot exceed paying 100% of average market rent. So this is aligned with the city's definition of affordability. So market rent tenants' rent can't exceed 100% of average market rent. Annually, we have market rent increases. So market rent increases play an important role in financial viability. They provide a stable and predictable revenue source. So rent, we ask that market rents are increased annually at a minimum of the rent increase guideline. So the rent increase guideline is a provincial guideline that sets the allowable rent increases annually for rents. On average, they range from about 2.1 to 2.5% annual increases. So we ask that at a minimum you raise your rents against the rent increase guideline. And all of this will be documented in the financial plan, the 5-year financial plan. And we ask that you can definitely evaluate market rents upon turnover, but still cannot go over or exceed that 100% of AMR. On the RGI subsidy, so this is the city subsidy. So what we are doing is we're shifting away from this one-size-fits-all approach that we've been doing for the last 35 years. And we are going to be moving more towards a tailored approach that enables yourselves to really respond to your distinct financial realities. We understand there's a spread of financial realities out there, and we want to make sure the RGI subsidy supports that. So essentially what we're doing is we're matching the RGI subsidy to your own market rents. So what that means is in year one, what we will do is take an inventory of all of your market rents across your building. and find what your tenants pay for market rents. We will take the average of those market rents by unit size, and that's what your RGI subsidy will be based on. It will be based on the average market rent your tenants pay by unit size. Now, this RGI subsidy essentially covers the gap between what your tenant pays and what your market rent cost is that that tenant incurs. Every year, we will increase our RGI subsidy to match what your market rent increases are. So we ask that at a minimum, you increase your market rents by the rent increase guideline. So if for example, in one of the years you increase your market rents by 2.5%, we will match that 2.5% and increase our subsidy, RGI subsidy, to match that market rent increase. All that being said, there is a cap on the RGI subsidy. So we ask that we will match your RGI subsidy to your market rent and then increase it against your market rent increases up to 80% average market rent. So there is a cap on that, on the RGI subsidy. It will be matched to your market rent up to 80% of average market rent. Vacancy loss still continues. We will cover up to 2 months of vacancy loss for RGI units. Now, both the market rent and the RGI revenue, all that will be outlined in that 5-year financial plan, and we will continue reconciling all of this annually. As for the operating expenses will be documented to the 5-year plan. They will no longer be based on benchmarks. It will all be based on your actual, so your actual operating expenses. So when you are completing the 5-year financial plan, take a look, use your prior year's operating expenses as a baseline and cost factor them up based on inflation, things like that. So we ask that all that will be documented to your 5-year financial plan. The mandatory capital reserve fund contribution continues. We are increasing that to 8% of gross revenue. We understand that, as in terms of operating expenses, your biggest operating expense used to be your mortgage, and now it's going to be your capital repairs. So the mandatory contribution towards your capital reserve fund will be 8% of gross revenue. Your operating expenses will no longer include a property tax cost because you'll be exempt from that. And in some cases, housing providers do have outstanding loans or debt. So we ask that any carrying costs or servicing costs be included as part of your operating expenses in your financial plan. Some housing providers even have lease payments. So we ask that, land lease payments be also included in your operating expenses in your 5-year financial plan. Now let's take a look at the surplus allocation. So like I'd mentioned, you have your revenue and then you have your operating expenses. The difference between the two is your net operating income or surplus. You're in your surplus. Now, at the moment, in the current world, the surplus is shared between the housing provider and the city. So we take 50-50. So 50% goes back to us, 50% goes back to you. In the new world, the new EOM world, we are letting you keep your entire surplus. Your surplus is essential in order to maintain your asset. So there are 2 areas, the 2 paths where your surplus will be allocated. One will be your capital reserve fund and the other will be your accumulated surplus. So at a minimum, we ask that 75% of that surplus, that in your surplus, be allocated back to your capital reserve fund. This is going to be based on your capital outlook. And it's really used to maintain and fund your capital plan. So if you have more capital, it's all dependent on sort of your capital needs, but at a minimum, it will be 75%. That could go up depending on your capital needs. The balance of that surplus, in this case would be the default is 25%, will be allocated to your accumulated surplus. So your accumulated surplus is really for you to support your ongoing operating and capital needs. It could also be used to make sure that you support your capital reserve fund. So part of that accumulated surplus could go back into your capital reserve fund, depending on what your capital outlook looks like, or if there are any, extraordinary capital issues. So what's staying the same versus what's changing? In terms of staying the same, things like providing deeper affordable units continues to stay the same. Centralized waiting list access for your RGI tenants to access your units stays the same. Operating and maintaining your asset in a good quality state of repair stays the same, and annual and mid-year reporting stays the same. What changes? The introduction of this 5-year financial plan. That's going to be something net new. And in that financial plan, it'll include your capital and operating, income verification for new market rent residents. So this is new where under the contribution agreement, which is what we're using, is the agreement that will get you your property tax relief. Under that bylaw, there is a requirement that any new market rent households, not existing, but net new going forward, market rent households be income tested to confirm eligibility for that affordable market rent unit. The access plan will be new, and that access plan is really documenting how market rent tenants and RGI tenants will be accessing your units. And then we have annual occupancy reporting. So annual occupancy reporting, I will sort of get to in a little bit, but that continues staying the same. So some of the benefits of the new Chipper EOM framework, I'm just going to go through them at a high level, and I've sort of touched on all of these already. But it's all about long-term stability with the new funding approach. Your financial plan really supports your long-term outlook. It's an opportunity to invest in more capital reserves for increasing that good state of repair. Continued partnership between the boards and the City of Toronto. We want to maintain that partnership. We think it's been great so far. Continued autonomy as a co-op and nonprofit. So we want to make sure you operate your business like a business, and we want to give you the autonomy to do so. Building capital capacity to meet your future needs. It helps generate revenue to support strong long-term operations on your capital position, and a framework to support housing projects as a whole. So what I did want to show you is a little bit about the financial plan template, just at a high level. What we did was we kept this very, very familiar for you based on things that you're used to. So this is mirrored against the AIR, the annual information return that you're already familiar filling out right now. It's all based on a set of formulas to help automate as much as possible. So there's very little work that you would actually need to do. The main introduction is the introduction of a rent roll. So that's the key schedule that will help us establish what your year one RGI subsidy will be based on your market rents. So that's something new that will be introduced as part of this financial plan. But that's really the new component. Everything else stays very, very similar to what you're used to in terms of the AIR. Okay. I'm going to pass it over to Leila, who will continue the presentation and talk a little bit about partnership renewal.
Thanks, Alan. So the EOM roadmap in the discussion guide outlined key phases in the planning process and beyond. And these early phases really focused on helping housing providers review their core information, including capital needs and also their financial position, while also building on the foundation needed to make informed decisions. So with this understanding, you're ready now to renew our partnerships and to enter into service agreements. So we're now moving from the planning into the implementation phase. And the transition will require ongoing engagement between us and also collaboration with sector partners who we'll hear from a little later. So in terms of our milestones for partnership renewal, I'll just walk over it through in a high level. So it's really organized into 5 key milestones, so each building on the last with a timeline. And the first is launching our discussion. So today, this webinar, this is our launch to really introduce the framework and kick off our work together. So from here, you can finalize your EOM planning actions, and ultimately, we want to make sure you take the time to get prepared before we head on to the next milestones. The second milestone is financial plan development. So you will be receiving a custom financial plan template from the city, and the template forms part of the service agreement and is a key schedule to really provide that individual operations and capital needs outlook for your housing projects. So once you've completed the template, then you'll send it back to us. And then we'll be in milestone 3, which is review and engagement. So we'll then review with you your financial plan and provide feedback. So in the meantime, we'll send you the service and contribution agreement for your review. And at this point, we are more than happy to review the full EOM package and with you and discuss. Milestone 4, so is the service agreement. So before signing the service agreement, it'll be important to review the terms with your board and members to approve the commitments made and really how you plan to operate. Then the service agreement is signed and represents a key commitment in this process going forward. And then finally, milestone 5 is the contribution agreement. So this milestone was really contingent on city council approval dates, and it's about signing a contribution agreement to formalize the new funding and administrative relationships. So overall, this process is designed to be structured and phased with checkpoints, collaborative with multiple opportunities for engagement, and practical with defined timelines just to keep our momentum going. And the goal really is to move from this initial discussions to fully executed agreements in a clear, manageable way.
Hi there. Hey, thank you so much, Layla. My name is Judy Lightbound, and I'm with Housing Services Corporation, and I'm going to talk you through some of your immediate next steps, recognizing this was a lot of information to receive today. I do want to say thank you to all of you for taking the time to participate today. It's nice to see many familiar names through the chat. If you recall, HSC facilitated a discussion with you in 2023 on end of mortgage, and we're really pleased to be here today to now help you navigate some of your next steps. So the city has provided you with a great deal of information today. And as Layla said, this is really just the start of a conversation between you and the city. Now that the city has laid out its partnership framework, you have something really tangible to start to have a conversation with them about what your future will look like. And while this may seem really overwhelming, like a lot of information hitting you at once, I do want to stress that these are really positive steps and a really positive plan that the city has outlined through its partnership framework. Operating under the Housing Services Act for the last 20 plus years has really proven challenging for boards and members alike because the Act dictated how you operated, how you were funded, what your relationship looked like with the city. It took away much of your autonomy and decision-making ability. However, the city's new partnership framework is intended to provide you with an opportunity to really re-establish your role in governance, in operations, and in making financial decisions. As the city team mentioned, the city's new partnership framework is intended to renew and modernize its relationship with you and to provide you as nonprofits and co-ops with predictability in your funding and stability in your operations moving forward. The city's new partnership framework is really intended to build on the collaborative relationship that it has built over the last number of years, and it wishes to expand that relationship with you. As the city's mentioned, you as a nonprofit and cooperative housing provider, you play a critical role in supporting the city's goals around affordability. You are a key partner to the city by providing much needed RGI units. And this new EOM funding model that's been outlined here really recognizes that role and simplifies your funding by tying it specifically to that role of providing RGI units. The new funding approach, which will be based on the provision of RGI units, will provide you with predictability, not just for your funding for 1 year, but predictability for you to understand how your subsidy is going to grow over the next 5, 10 to 20 years. You'll have a better understanding of what your funding trends are going to start looking like and provide you with much greater flexibility to build, grow, and use your surpluses to meet your operating and capital goals. The new funding approach will be driven by the development of your new financial plan. And as you begin to build that financial plan template and start to use it, you'll do that using your current starting point. So what Alim has outlined is we want you to start with what your current financial realities are. And then the goal in terms of building out that financial plan is for you to understand how you have the opportunity to start increasing your revenues annually, thereby strengthening your financial position. The 5-year review cycles allow both you and the city to check in and consider any new realities that you might be facing, either on the expense or the revenue side, and to make adjustments over those 5-year cycles. This should provide you with some comfort that this is not a set it and forget it. This is not a one-time and we'll see you on the other side of the 20 years. This is a living financial model that can be adapted and be flexible through those 5-year check-ins. And we know that any kind of change is scary, and a change such as this, moving outside of the Housing Services Act into a very different funding model, might feel like it's really moving you outside of your comfort zone. But I would invite you to take a moment to consider that this is really good news for you. It is a maturing of the funding relationship that you have with the city, and one that supports you to be much more independent and to start to make decisions that impact your nonprofit or co-op. By tying the subsidy entirely to your average market rents or housing charges, you are able to understand exactly what your subsidy level is going to be now, in the next year, and as you are able to increase those housing charges or rental rates. You can start to predict what the additional subsidy will be that you'll be receiving year over year. This model will allow you to stabilize your operations because you can retain any surplus generated to support your capital and operating needs. This is definitely a good news story, as it allows you to start to do some long-term planning about how to best use those reserves to meet the needs of your residents or members and to ensure your building remains in a satisfactory state of repair. So what's next, and how do you get started? As mentioned, following this session, the city is going to provide you with the financial plan, a template, and ask you to start to fill out that template. But this is much more than completing a spreadsheet exercise. Let's talk a little bit about some of the things that you should be thinking about over the coming weeks and as you start to fill out that spreadsheet. Before I begin, let me just take a moment to remind you of how critically important it is for the board to be involved in the next steps of this planning process and completing the financial template. The board of directors is the only group with the defined legal duties to oversee a process such as this, and only the board is able to sign the new service and contribution agreement. It is in fact the board's duty to understand the financial impacts of end of mortgage on your nonprofit or co-op, and to understand the financial terms that are going to dictate how you're going to be operating over the next 20 years. That is not to say that your property management staff, that your members, or that your sector organizations don't play a critical role. They absolutely do, but the board must be actively involved in all of the steps that Layla outlined over the next 3 to 4 months. So practically, what should be some of the first steps of the board? First, I would suggest that if not all your board members are attending this session or one of the 4 sessions, then share the recording of this event and the slides with all of the board members. It's really important thing for all of your members of your board to have a good understanding of end of mortgage and have the same understanding of end of mortgage and the city's new framework. The next thing you might want to do is consider forming some kind of working group that can work together over the next 3 to 4 months through this process. That could include just your board. It might include your staff, some of your members. You may also want to engage your auditor or bookkeeper through this. The last thing that I would suggest is that you might want to have some honest conversations together about whether you feel that you have the capacity to work through some of these next steps. As I said, you may want to engage with your auditor or bookkeeper to keep them involved. And of course, reach out to the city as well as your sector organizations for assistance. I do want to remind all of you of this planning tool that is in the city's discussion guide. And as the city mentioned, we are all now at step 7, entering into negotiations with the city for the new service agreements. But you may want to revisit some of the tools, resources, and discussion for some of these earlier stages to help you get prepared to engage with the city. So just a reminder that the city's discussion guide and a number of other tools and resources remain available to you on the city's website through that housing provider portal. Please also remember that your sector organizations, OMFA and CHFT, have a number of additional resources, and they're going to be going over those with you before we end the session today. I'm not going to spend any time today going over these planning steps, but I am going to outline some key information that you might want to collect and understand in order to support you in engaging with that financial plan tool template that's going to be coming your way. So the new service agreement and the financial plan is going to set you on a course for the future of your nonprofit and co-op. And as you sit down as a planning group, as a board, staff, or members to think about completing that financial plan template, you also may want to think about 4 key elements: your future goals, your financial position, your operations, and the state of your building. And I'm going to go over each of these in the next couple of slides to give you some questions and some information that you might want to collect when you're about to sit down to go over that spreadsheet. So let's start with your future goals. And by this, I mean, what do you see for your nonprofit and co-op over the next 20 years? Do you wish to remain exactly as you are, which is totally fine, but it's important that that conversation takes place. But you also might want to consider, are you interested in growth? Are you looking at whether that's through new development or expansion? Are you interested in merging or amalgamating with a nonprofit or a co-op? The reason that this conversation is so important, and it's important for you to have it now, is that if you are thinking about changing how you operate, whether that is merging, amalgamating, growth, or changing your structure altogether, the time to have that conversation with the city is right now. So if you're starting to look at the financial plan and you're thinking about doing something other than sort of maintaining as is, please reach out to the city and talk about what those goals are. The next item to consider is obviously your financial position. And as the city mentioned, they want you to start the financial planning process based on your current realities. So you are just collecting your current financial situation. But it's really important for you to know what those are. You want to know what trends your nonprofit or co-op is facing with regard to trending towards a surplus or a deficit position. It's also really important for you to understand about the financial plan, particularly because the city's new funding model is going to be based entirely around RGI subsidy model, for you to understand what other revenue streams you may have coming in, and particularly what is the current subsidy levels that you are receiving. And to do this work, you also are going to need to know what the current market rents are, or the housing charges that you are currently charging in your building, and how those compare to the community around you. And why this is so important is because this will be the foundation of the financial plan that you are building with the city. It's important for you to understand what the new model will mean to you. And the only way that you can know that is by knowing what your current situation is and how the new model is going to change. The next piece that you should consider as you're starting to build your financial plan is the operating realities of your buildings. Questions to ask include whether you have enough revenue to cover your expenses, are your arrears and vacancy rates being well managed, and the trend of some of your higher expense items, such as utility costs. What are you seeing as those costs are going up? You may also want to consider at this time whether you have the right staff levels to be able to properly property manage. Moving forward, you're going to have greater autonomy, meaning you need to have stronger governance in place to support that. That includes strong policies and processes that are being universally followed. So now is a really good opportunity to check in on those. And this matters for so many reasons in order to build the financial plan. It's really important for you to understand the various components that are going to be making up that financial plan. So the breakdown of the number of market versus RGI units that you have, you need to know what your target levels are and where you sit against those target levels. That's really going to impact the financial model. You also want to know what is your current vacancy rate, because under the new model, that's going to be capped at 2 months of vacancy. So if you have more than that, now is the time to understand why and what you can do to address it. It's also important for you to understand what your operating expenses are now and looking forward, so that you can know whether you're going to have sufficient revenue to meet from your rent, from your housing charges or your rents, to be able to effectively operate and generate the surpluses that Alim was mentioning to support your operating and capital reserves. And then finally, it's going to be really important for you to have a good understanding of the state of your capital repairs and whether you have enough capital reserves to meet the capital repair needs that you have. And spoiler alert, most of you will not have sufficient capital repair funds to meet all of your capital repair needs. That is very normal and what we're seeing across Ontario. But that doesn't mean that it isn't an important exercise for you to start to look at what those capital needs are. And it's important for you to start to think about prioritizing those capital repair needs to be able to ensure that your building remains safe for members and residents moving forward. So this really matters as you're starting to build the financial plan, because a core element of that plan is going to be your 5-year capital plan. So now is the time for you to dig up the building condition audit that you have in place that the city funded for you. If you're not sure where that BCA is, please reach out to the city and get a copy. Your BCA is going to look at all of the capital needs that your building has over the next 10 years. And definitely, you are not going to have enough funds to be able to meet everything that has been identified within that BCA. That's not the intent of the BCA. The BCA goal for you is to take a look at what the engineer identified as what needed to be done, those priority items over the next 1 to 5 years. You need to understand what are those core elements that need to be completed in order to ensure your building is going to be in a satisfactory state of repair. Those are the numbers that you're going to want to consider as you're starting to build that 5-year capital plan and your financial plan. You need to understand this data so that you can understand what is that actual gap between those core needs over those next 5 years and what you have in your capital reserve, and include those as you're building your financial plan to understand how you can build sufficient surplus to be able to go into your capital reserves to meet those needs. So while change might be really difficult and this process overall might seem overwhelming, I do want to leave you with optimism. The city really wants to renew its relationship with you and to work collaboratively to implement the new Chipper EOM framework. The framework is intended to modernize how its funding relationship with you, and by providing you with predictable funding and the ability to retain surpluses, the city really believes that this new framework is going to provide you with financial sustainability moving forward. But this model depends on you as nonprofits and co-ops to play an active role in taking the next steps towards building that financial plan, a capital plan, and entering into the new service and contribution agreements. So before we leave you today, I do want to point out that you are not alone in this process. This is taking place across Ontario, and you have some really strong supports through the City of Toronto, as well as through your sector organizations, ONFA and CHFT, who are now here to review some of those. So I'll turn it over to to Leila, I think, who's going to introduce our next speakers.
Thanks, Judy. Now, as you mentioned, you folks play a critical role in shaping the future of your organization, and we're at a really important transition point. But at the same time, as we mentioned, you're not doing this work alone. There's sector supports and resources available. So we're now going to hear from CHFT and ONFA, and I'll hand it over to Lindsay from CHFT.
Hi, everyone. Can folks hear me okay? I was having some connection issues. Okay, great. So I know we want to leave a good amount of time for questions, so I'll keep it brief. My name is Lindsay Denise, and I support the CHF team with EOM planning. Most housing co-ops in Toronto are members of CHFT, but in case you need a bit of a refresher, we do provide some different supports and services for housing co-ops in the City of Toronto, in Durham Region, and York Region. CHFT is over 50 years old, and our core mission hasn't changed. We promote the development of housing co-ops, and we support existing co-ops through advice, education, meeting support, bulk purchasing, and more. We also work really closely with other housing co-op federations across the province, as well as CHF Canada, to deliver co-op programs and advocate for co-op interests at all levels of government. And just to to talk briefly about the support that we're able to offer co-ops in Toronto who are planning for the end of their mortgage and planning for negotiations with the City of Toronto. We know there's a lot of info to take in today, and I just wanted to say that a key takeaway I'm hoping that co-ops will keep in their minds is reach out to us. So we can help you figure out where you're at in the EOM planning roadmap, what phase you're in. We can help you figure out what your next steps are, what you'll need to do, and how to get it done. We are able to provide the support not only to members of CHFT, but if you're one of the few housing co-ops that are not a member, we can help you out too. So please just reach out to us. Our contact information is here on the slide, and you can also get it from folks at the City of Toronto as well. And so some of the things, just some examples of things that we can help out with is training and education. We can help you develop your financial plan and look at some scenarios with you. We can help you retain consultants to develop your asset management plan or building condition assessment if you need that. And we're also able to support you directly with negotiations. So we've been out to a couple of introductory meetings with the City of Toronto and some co-ops, and we're here to support you throughout that negotiation process. So again, if you're a housing co-op in Toronto, reach out to us and we can connect you with one of our advisors. And that's it for me.
Thanks, Lindsay. And now we're going to hear from Andrew from ONFA.
Thank you and good morning, folks. Andrew McKenzie, the Director of Operations here at ONFA. And I wanted to talk a little bit about the Sector Transformation Enterprise Program, something we as ONFA developed at the beginning of the end of mortgage discussions that came from the province in around 2021, 2022. And the program for us, it really here to support similar to CHF. We have about 100 of the 139 said nonprofits that are in the City of Toronto as members through this process. And a lot of what we can support with has been discussed, but I did want to talk about a few of the areas as to why we created the STEP grant. So if we want to go slide a little bit. Sorry, I'm not controlling it. Next slide is fine. So the reasons why we created the STEP grant, the STEP program was, again, as mentioned, I think Judy articulated very well. There's a gap in readiness in general. This is a whole new world for everybody. So we're really trying to get people to get their minds around what this means in the context of the time and place we're in, and capacity constraints. I know for some of the agencies are larger and have a lot of departments that could probably develop, build, and go through their financial modeling and performance, etc. But some of us don't have that luxury or not that large. So we wanted to create a program that can support that. And then also to truly understand the opportunity within what the end of mortgage is at the end of mortgage time is offering our sector. So it's really around putting out what are the instances of what your organization is and how do you look as an entity and where you can go. So it's really sorry, we'll go next slide. A couple of things. So we're here to offer strategic and operational and financial assessments. So we have that as part of the program. Facility and capital assessment. So if you're out there and you're looking to get updated or refresh BCAs or understand your conditions of your facilities, we can do that as well. And then through those two first steps, we're here to develop and help you implement a plan. So it's really that whole notion of gathering, understanding what your state is, and giving you a few options as to how to move forward into the framework with the City of Toronto. We actually, since the onset, before we've gotten to the stage of where we're sitting at negotiations, we have a lot of resources, templates, etc. for members. And in the instance of the City of Toronto, if you're not a member, please reach out to us. We'd love to share this stuff with you as well, because we want people in the sector to be prepared. And for some members, we were able to obtain a significant amount from the provincial government, whereas we can help fund you through this process. Now, it's not enough to fund everybody through this process, unfortunately, but in some instances where you have a demonstrated need where you want to do this process, but you don't have those funds available, please reach out to ONFA and we can probably help walk through this, because some of the planning resources is not free. But at the end of the day, we want to make sure everybody has a leg up in the preparedness process so they can enter into the framework discussions with the City of Toronto. So if we pop a couple of slides through, I think I won't go through what we're seeing in the sector, because I think we all know what we're seeing in the sector. We'll go to the last slide, actually. We'll talk about just how to access us. So really, I'll leave this up here for a moment. Through the STEP grant, to the STEP process. I keep saying grant because grants are available. That's one of the things. But we have access to consultants that do what I mentioned, which are BCAs, strategic planning reviews and financial reviews, and also we have the resources. So again, a lot of it's at our website. If you actually have specific questions for us in the sector as to how we can help you, there's an email address directly for this planning process, and we'd love to hear from you. Again, member or not, if you want to become a member, please reach out in the same way. But if you're still not a member of the City of Toronto, we want to support everybody in the City of Toronto through this process. So please reach out to us. As again, I think everybody articulated on this call, it's a time really to get prepared so that we can enter into the new world that we're going in the next few decades. So again, offers here to help.
Thanks, Andrew. Paul's just going to go over a few closing remarks for us.
Sure. Yeah. Thanks again for everyone for joining and for sticking with us. I know there was a lot of slides, but we'll be connecting in the next little while as we'll be setting up some time with your housing consultant to go through the financial plan template and have any one-on-one discussions. So in the meantime, if you have questions, feel free to reach out to your housing consultant or email hss@toronto.ca. We'll get those financial plan templates out to you, as Maria mentioned. And we're happy to move this forward with you, and we're looking forward to the ongoing partnership. So thanks again for everyone for joining, and we'll be in touch shortly.
Thanks, Layla. So thank you so much for joining us, everybody. And I want to remind you all of your post-session survey. As soon as you close this window and this webinar ends, a new window will automatically open for you. And we ask that you please complete this survey at the end of the session. The reason is that this survey helps us to improve the quality of all our future training endeavors. So tell us what you liked, what you loved, and what you couldn't stand so we can improve and be the best that we can be. With that being said, I'll pass it now over to, oh, it's still me. That's it. Thank you. From all of us here, the presenters, the panelists, and all the attendees, thank you so much for all of your help. Remember that you will receive, not now, but at the end of this webinar series, you will receive the Q&A questions, the recording, and the presentation. So again, please fill in that survey. It will really help us a lot. And that's it from us, folks. Thanks for your time and have a great rest of your day. Bye, everybody.